A wealthy tax a levy on the total value of personal assets, including bank deposit, real estate, asset in insurance and pension plan, ownership of incorporated businesses, financial securities, and personal trusts. Typically, liabilities are deducted, resulting in net worth assessment. It's designed to target wealth inequality by taxing the rich proportionally to their financial holding. In Malaysia, while there is no current implementation of a wealth tax, discussions have been ongoing. The country primarily relies on income and consumption taxes. Proposals for Malaysian wealth tax suggest it could include assets like vacation home, art collection, share, bond, and fixed deposit. The aim would be to encourage the reinvestment of wealth within the nation and potentially redistribute wealth more equitably. Recently, the government has proposed a luxury tax on the high goods to increase tax revenue from the wealthy percent of the population.
The first issue is investment impact market efficiency by allocating resources to their most productive use. When investors act on accurate information, prices reflect true asset value, promoting efficient markets, and a poor investment decision due to misinformation or irrational behavior can lead to mispricing and inefficiency, distorting resource allocation and economic growth. Next is increased tax dispute can arise when tax laws are unclear or when businesses and individuals disagree with tax authorities on how much they own. This can lead to more audits, legal battles, and higher costs for both taxpayers and the government, creating uncertainty and financial strain.
Assalamualaikum, my name is NURUL binti HAZAR and I will continue on the suggestion to the issue of impact investment and market efficiency. So, to minimize the potential negative impact of a wealth tax on investment and market efficiency, Malaysia could consider a phased and targeted approach. So, this means gradually introducing the tax over several years, starting with a lower rate and specific threshold targeting on the ultra-wealthy. By phasing in the tax, the government allows the investor and markets to adjust slowly, reducing the shock to the system. Additionally, setting clear high thresholds ensures that only those with substantial wealth are affected, thereby protecting middle and upper middle class investors who are vital to the domestic economy. This approach also provides time to refine the tax structure based on initial feedback and performance, making adjustments to ensure that it promotes fairness without deterring the investment. Therefore, targeting the wealth tax in this way can help maintain investor confidence and market stability while addressing wealth inequality.
For the next suggestion, I would like to suggest government to enhance dispute resolution mechanism. So, as example, government can use advanced pricing agreements (APAs) to promote the use of APAs between tax authorities and taxpayers to preemptively resolve potential transfer pricing disputes. This provides certainty and reduces the likelihood of future disputes. The second one is to improve arbitration processes, establish or improving existing arbitration mechanisms for resolving tax disputes. A neutral, efficient arbitration process can provide timely resolutions and reduce litigation costs. The next one is capacity building for tax authorities. Invest in the training and development of tax authority staff to, to better handle complex tax issues and disputes. As an example, skilled tax officers can more effectively interpret tax laws and regulations, reducing the incidence of dispute. The last one is a clear and consistent guidance. The government need to provide a clear and consistent guidelines and interpretations of tax laws of taxpayers. Ambiguities in tax legislation are major source of disputes, so clarity can significantly reduce their occurrence.
In my opinion, implementing a wealth tax in Malaysia could bring both good and bad outcomes. On the positive side, it could help the government collect more money, which can be used to improve public services, reduce national debt, and support social programs that benefit everyone. It could also help reduce the gap between the rich and the poor, making society fairer. This kind of tax ensures that those who have more money will pay their fair share. However, there are many challenges to consider. One major issue is figuring out the value of assets like houses, artwork, and businesses, which can be very difficult and lead to disagreements. There is also the risk that wealthy people might move their money to other countries to avoid the tax, which would reduce the money the government hopes to collect. Additionally, it would cost a lot to enforce this tax properly, which could be a burden on government resources. So, while a wealth tax in Malaysia could bring in more money and promote fairness, it would need careful planning and effective management to address these challenges.
In conclusion, the implementation of a wealth tax in Malaysia may get tricky, particularly concerning tax avoidance and capital flight, which could undermine its effectiveness. Then, these issues could also deter investment, impacting market efficiency negatively. However, these issues will be resolved by addressing these concerns, includes enhancing dispute resolution mechanism is crucial. Then, measures such as advanced pricing agreements and improved arbitration process can mitigate disputes and provide clarity for taxpayers and authorities alike. Additionally, capacity building for tax authorities and the provision of clear and consistent guidance are essential to ensure the smooth implementation and enforcement of the wealth tax, ultimately fostering a fair and transparent tax system.